Testing, testing, 1, 2. Welcome to Daily Bread with Tom Hartman. Let's see how that sounds. Terrible. Change the mic.
All right, testing 1 2, testing 1 2. All right, that seems to be working. All right, welcome to Daily Bread with Tom Hartman. I'm your host, Tom Hartman, for November 21st, 2025. What day it was today? We've been talking about all week this idea of this negative gamma spirit bomb, the idea that the market, especially the zero DTE market, the option space, could be weaponized in order to crash the market. And we talked about on Monday the idea of passive investment flows just to generate the concept of forced buyers and forced sellers, even though forced buyers and forced sellers exist all over the place, as we saw on Tuesday, which was about zero DTEs and how market makers, dealers need to hedge their positions when they're selling these options by by buying the underlying, either future stocks, and sometimes when it's zero DTEs, they can only hedge with zero DT options, which exacerbates the problem. And the idea here is that it can cause major volatility in markets to have a sudden. So what happens with negative gamma is that as these, let's say in this case, puts become monetized as the market moves down, then you have forced selling that happens on the parts of the market makers in order to stay delta neutral. They have to sell futures, they have to sell stock, they have to sell zero DTEs. And this could cause a vicious cycle that increases the value of the puts, causes more selling that needs to happen in order to hedge, and drives the price lower, and so on and so forth. And it looks like we might have had something like that happen today. I mean, how beautiful that it happened right for our last day here. And it happened based on NVIDIA earnings. Now, here's the interesting part. The whole worry was that NVIDIA would miss earnings, right? They're a $4.53 trillion market cap. You don't want to see that happen. And so that was the big concern. However, it looks like what happened was that the NVIDIA beat earnings. They beat. So we had a huge rally or significant rally yesterday on Wednesday into the close which I missed. But hey, what are you going to do? This happens after markets. The news came out at 4:10, and so futures for prop firm trading were closed, and then you had a big move up in Nvidia. Actually, just pull up that chart so you can see. Actually, forget Nvidia. We care about the market in general here. All right, so we had here on the Nasdaq yesterday. We had first this initial pop, and then it sold off before the end of the day, and then it rose again in the open. So that was a pretty significant rise up. It was a rally of about, let's call it 2.26% into the overnight. So then we opened up today and we rose some more, and then we sold off. Right. So what looks like it happened here, I don't have the whole post-mortem, but what looks like happened here is that the implied volatility, so the options, they're priced based on implied volatility. The more volatile, which is to say, the more the range of possible outcomes is broad, the more you have to pay in order to take the bet that a particular outcome might occur. This makes sense because whoever's taking the other side of that bet, they're like, well, you have to pay me more because the odds are more in favor that your thing might actually work out. One second here. More likely that your probability might work out. So the higher the volatility, or higher the VIX, or whatever the asset that you're actually dealing with, the more likely that the stock, the more likely that the option will be expensive. And so what the options trader wants to do, especially the zero DTE options trader, is that they're looking to play the volatility. So as the price, let's say, of the asset, in this case Nvidia, moves up because it beat earnings, the idea is that they would be able to then sell that option later on for more to the people who need those call options. But what can happen is that you can be right directionally with options, but wrong with the implied volatility. So what happens is that as the price petered out, as the day moved on into the morning and the price petered out, the range of possible outcomes narrowed down. The volatility came down. And as the volatility comes down, the options naturally lose value. So they're right, they're up, but those options then start losing value just by virtue of the volatility coming down. Well, what happens with that? Well, then either those options can expire worthless, or they become more worthless, or people have to sell those options. They have to sell the call options because it's not worth holding on to them anymore, even if you're above the strike. So then the call options go away, and then the put options end up becoming increasing in value. And then we saw, I forget. We don't have concrete details on this, so I don't want to spread false rumors, but it looked like selling was happening throughout the market. Let me see if there's a tweet for that here. 1 second. I think there might have been a tweet for this. Let's see. All right. All right. Well, let's just read a couple of these tweets that came out today talking about this. So we had the Kobesi letter who talked about it. It says that what just happened? It's the fastest reversal since Liberation Day. The S&P 500 just lost about $2 trillion of market cap in 5 hours. Nvidia went from plus 6% to minus after reporting record revenue of $55 billion without any new headlines. Why did this happen? Well, what we saw here is that in the morning it rose up. Then we had the Fed. Some Fed members came out and were saying things like the market's overvalued, that we have to slow the pace of rate cutting, a bunch of hawkish rhetoric that happened. Then we had a massive sell-off. Whether that's the reason, I don't know. There was also a bunch of put buying that was happening throughout the indices, and then that moved into single name stocks. Then we had over here, Spot Gamma tweeted out 12 hours ago, the amount of S&P 500 put buying since 10 a.m. is nuts. Nearly 8 billion in negative delta. 2.5 billion of this is SPY. 4 billion of this is zero DTEs. All right, so that's a massive amount of zero DTEs that was actually purchase puts to the downside. So those are the ones that have the most amount of gamma, which means as they move into profit, they move into profit faster than any other option you can have. Right? Every other put on the calendar is will move up in value less than the zero DTs. That's why they're so attractive. They're so cheap and they have huge convexity. And then as that happens, market makers need to sell the market or even sell zero DTEs or buy zero DTEs in order to hedge their position. We had this tweet 9 hours ago from Tier 1 Alpha who says, in structurally weak periods, selling can trigger further selling. Excuse me. In structurally weak periods, selling. All right. In structurally weak periods, selling can trigger further selling, irrespective of fundamental sentiment and price. For a bulk of the market, fundamentals are simply not part of the algorithm. So this is implied CTA position in U.S. equities. So these are algorithmic systems that are just designed to buy and sell depending on the volatility and other metrics. And so once volatility increases, they too become forced sellers of the market in this scenario. And then we have a drop here that that's outlined. So very interesting that these things are happening. So this is all just to reiterate the dynamics of the market, the dynamics of the forced buyers, forced sellers, the negative gamma that could occur because of options positioning, and how little money can be used in order to cause a drop, and how weak a catalyst could be. In this case, it wasn't NVIDIA even missing earnings. It was just that implied volatility faded as we had some bad news float around a little bit. Jobs numbers, the Fed speakers, and then the put buying, and that's all that's necessary in order to pull it down. It makes me wonder what happens if regular retail traders like Wall Street bettors realize that this is possible and that it can be done throughout throughout the indexes, throughout single name stocks. I don't know. I thought we'd see a bunch of GameStops at AMC's again and again and again, but people just don't have enough money to do it. I get it, but I worry about that happening because it could completely destroy the way that our markets work. You give fire to humanity, and all of a sudden they're going to start burning stuff down. So I just wanted to play a couple of clips here from Brent Kobayashi. Brent Kochuba. Why did I think his name was different? Anyway, Brent Kochuba from Spot Gamma, who's talking about the November OPEX. So that November OPEX is tomorrow. So we're not even out of the woods yet when it comes to what can happen with the volatility in the options pricing. But then also there's a video from him 3 years ago talking about the dangers of this. So let's play that in order to make the case.
There we are. This is the delta notional for November 21st expiration. This is as of last night. Now, we look at things in terms of delta notional at Spot Gamma because this tells you the stock equivalent. We all know how 13Fs are a load of BS in terms of like one contract equals 100 shares of stock. Well, the pervasive way that a lot of these other bank desks and people put this data out is one put equals 100 shares of stocks when they're telling you about $3 trillion notional of some expiration because they're assuming one contract equals 100 shares of stock. That's fake news, obviously, as we like to say around here. So what is the actual weighting? This is actually quite bearish. Normally into an expiration, and in recent expirations, we've seen 80, 90% of the delta value in calls, right, over puts. So the fact that we're at 50% in ETFs and index flow is really quite big. This is actually very negative in the single stock space. Usually single stocks is quite a bit higher. So even the calls are a larger portion there. There tend to be more calls than puts in the single stock space just anyways. So this is, when I look at this is a put weighted expiration, which if NVIDIA starts to move, then what? These puts all get crushed, right? And so there's a lot of This is a massive expiration. It's a decent size expiration. December is much larger, but this is just another thing that can add to the volatility of this event, right?
All right, so it's the two things he's mentioning here. One, that it is a put-heavy market, right? And so he was expecting that potentially with a beat on earnings from NVIDIA, that those puts would get crushed. They would lose value, and they would be sold. That means that the hedges would be sold for the market makers. That volume would then be added back to the market. In order to buy futures by spot and all that sort of thing, and then calls will go up in value. As the calls go up in value, we have the negative gamma that happens on that side, and the market gets chased up higher. You know, so it could just as easily have had a 3, 4, 5% move up, in the same way that we had a move down. And then he's also mentioning in here that December is an even bigger option expiry. It makes sense because we have not only the weekly, the monthly, and the quarterly for December. We also have the yearly end for that. So I'm expecting some fireworks this December, even though we normally get that. When we do get fireworks in December, it can be pretty brutal. So I would hold on to my hats and set up your options, set up your trades accordingly, because volatility can go through the roof. All right, here's the last part I wanted to play here. Let's just get that video. So this is from 3 years ago. All right, so it's gonna get a little wonky. I just want you to hear this section here where he's talking about. This is 3 years ago, talking about the effect of zero DTEs on the market.
Every day, and obviously the Qs do as well. You don't want to ignore those. And so, okay, Brent, great. You've made your case that there's big flows here in zero DTE, but what is the impact? So again, I encourage you all to watch the video that we did that really walks slowly through this. I'm just going to buzz through these before we jump to the hero indicator. But the key insights here, again, we have record options volume. Each month seems to be a new record, all-time record in total options volume. This chart is from actually August. I know we just had a situation here last Thursday and Friday, I believe, were the 4th and 5th largest volume days of all time. We did somewhere around 60 million contracts, where the monthly average is typically around, the daily average is usually around 40 million. That's all equities, indices, ETFs. So 60 million is a big deal, especially when it's not an options expiration.
We're way higher than that now, by the way. Way more options volume.
Day. Like we're talking random days here, right? I think on the quarterly expirations, everyone goes, okay, great. Well, that makes sense. We have huge volumes on a quarterly expiration because everybody's got to trade, to reshuffle positions and the like, and you get big block trades. But on a random Thursday or Friday, doesn't really make quite as much sense. 40% right now in short dated options volume in the S&P. That's from Goldman. We actually calculated this for the Wall Street Journal, that about 50% of overall volume is meaning in equities and the like, is less than a week. So for all of you are probably aware that while we have daily expirations now in the SPX, SPY, and the Qs, you can still only trade next Friday's expiration for things like Apple and Tesla. So if you look at the volume that's taking place in 5 days or less, expiration is about half of overall equity volume, equity options volume, is there. So what we had talked about was, and we were again accused of a little bit of fear monger here, but we talked about the fact that this short dated volume is the stuff that flash crashes are made of. And we said
the short dated volume is the stuff that flash crashes are made out of.
That because the fact that if you look at options, they're essentially leverage, right? And what you're doing when you're buying calls or selling puts or whatever it may be is you're basically requiring that somebody on the other side, in theory, has to hedge that position. So I can spend a few $1,000s buying some call options, and in theory, someone has on the other side of that trade, if they're a dynamic hedger, has to buy thousands or hundreds of thousands or millions of dollars worth of hedge, right? Depending on what the size of the trade is. So that is what the leverage of that position is. Options, obviously, there's the convexity component. I'm kind of considering that leverage as well, right? So what happens now is we're getting this flow that comes in at the start of day and it comes out by the end of the day, and it is dominant. It's a dominant percentage of the overall options volume taking place, and overall options volume is exploding. And so this is adding leverage into low liquidity scenario. Now, we actually think, and we make the case again in the video, that the bulk of this flow is actually not retail trading, it's institutions. And it could be, again, dynamic hedgers, market makers, vol traders, et cetera, that are actually using these options positions to offset risk. So instead of buying futures, maybe you buy some calls, right, that expire at the end of the day, so you don't have to buy those futures. But as this volume grows, as it becomes a larger percentage of overall volume, we think that the sort of non-dynamic hedging component is going to grow. And nonetheless, even if it is sort of people managing risk, it still has an impact in the space, in equities, as a result of the hedging flows that are an offshoot of anybody trading. If I buy 10,000
there we go. So
at the money calls, and that order gets pieced out to a bunch of different counterparties, we don't know how everyone's going to hedge. We don't know what everyone's position is. And we don't know how they're going to react to that volume. And so,
right. So that's the idea here, that this causes unpredictableness within the market because of how quickly market participants need to hedge, that it's institutional money making these plays, and it can cost millions of dollars in order to make these moves, which is not necessarily crazy. If a hedge fund can spend $5 million, $6 million in order to move the market 2%, maybe they do it. Maybe they do it. Who knows? I always remember that Jim Cramer video where he talks about manipulating the market in order to sucker retail traders in and out. There's all kinds of things that are morally wrong, but that get done all the time. All right, guys, that's it for this week's Daily Bread. We went over a lot. Negative gamma. It's just absolutely brutal, the idea that this might happen. What do I call it? The spirit bomb, just to cap this off. It comes from a Dragon Ball reference where Goku, the hero of the story, is able to gather energy from other people and other planets in order to create a bomb that defeats his enemy, a greater power that he could wield on his own. And I fully expect to see that power wielded inside of the markets, either by retail traders or by institutions, because there's just too much money on the table. I just want to be aware of it. I want to be positioned for it, and I don't want to be over leveraged, so that my life is not ruined when these flash crashes occur. And they can occur way more often than you might think. Way more often than you might think. Especially since it's been a few years now that people are understanding the dynamics of this. I'll be back on Sunday for Sunday Fuel. Sacred Prophet will be there talking about the market moves. There's all kinds of stuff happening with MSTR, with Bitcoin, which appears to be in a bear market, with what we're seeing from different participants, Tom Lee, Raoul Powell, Michael Saylor inside markets. We're going to take a look at that crypto style. We're also going to take a look at what's going on in equities and what levels to look at. We're going to have a lot of information that happens after OPEX tomorrow, and so all kinds of moves that we could prepare for next week. I encourage you guys to participate. There's no point in being aware of this and not finding ways of making money for it. That's what life is as a trader. And if this is a time of volatility, well, you got to learn how to turn volatility into gold. And that's what these videos are for. So thank you so much for watching, and we'll be back next week.